Let's say you're getting a $500,000 property. You're putting down $100K as your down payment. Again, 7% interest rate for a 30-year loan. Your all-in initial cost, including furniture, setup, closing fees, all the stuff, comes out to $150K. Now, assume this is an Airbnb and the cash flow is $12,000 per year after all of your expenses. If you were to calculate a cash-on-cash return based on these numbers, this would be an 8% return cash on cash, which is not exciting at all relative to how much risk and time you're putting in and compared to your other investment vehicles. But remember, you are making money in other ways. How much is that worth? Let's assume the market appreciation here is 4% per year. You can adjust that as you wish. And over time, you're also paying down your loan. You can figure out how much that would be in an amortization table. And in this specific scenario, it is between $4,000 to $5,000 per year for the first 5 years. Let's say between tax write-offs and enjoyable business expenses, you get another bonus of $5,000 per year in gains. And you can build a table just like this, showing year 0 through 5, for example, what your net annual gain or loss is. Year 0, as we said, is negative because of the initial investment. And year 1 through 4, you're getting the cash flow and some of those other benefits from a tax standpoint, your business trips, whatever. And these add up to $17,000 per year. At the end of year 5, if you were to sell the property, you would be selling it at an appreciated value of $608,000. And your loan balance at this point is also reduced to $376,000. This you can also find from the amortization table at year 5, what your remaining balance is. This chunk of equity that you now have is definitely bigger than what you started with. And even after you factor in, say, 6% for real estate agent commissions and adding in the cash flow for the year, you would end up with $207,000 in year 5. You literally just put all of this into Google Sheets or Excel and use the IRR formula, and it returns an annualized rate of 16% for this investment. The biggest benefit of this metric is that it includes all the ways that you are making money, like the cash flow, the appreciation, loan pay down, and whatever other tax or other less tangible benefits you want to include, and combines all of that into an annualized percentage that you can now take and compare with another rental property that you're considering, or compare it with a different scenario of the same property, or compare it with another investment vehicle altogether. Like here in this example, is the estimated 16% annualized return worth your hassle and risk? Maybe, maybe not. That's a very personal decision, but at least now you have a number as a starting point.